Today what we're going to do is talk a little bit about the VC market, especially in the States and globally, how it's evolving. We have Andy from Silicon Valley Bank who hasn't arrived. He just landed in Guarulhos. He'll be here at 11:57. So we thought about pushing off a little bit, but we'll just start, and whenever Andy's here, he'll join us. I'm Rodrigo from Redpoint, and Jeff. I met Jeff when I was actually trying to raise my own fund, experimenting with the idea. Sat down with Jeff for 15 minutes in the valley, and he destroyed my idea. He showed me everything I was going to do wrong, and right there I realized that I had a lot to learn, right? Jeff has been in the business for quite some time. I'll let him talk about that. I'm not going to be impolite to that point. But he lived through it all, right? He started back in the 80s. He saw the bubble in 2000. He has been a general partner from 20-something years.
Too long.
Too long. But he has seen the valley evolve and has been running a top quartile venture for ever since. So that's Jeff. And the idea here is to, I'll pop a couple questions just to get the conversation going, but it's mostly about you, about what you want to know, what are your doubts, and considerations. So feel free to ask at any time. If you don't ask, I'll just keep shooting questions, but it's much less interesting than if you do ask, right?
For sure.
Anybody has any questions to start?
No, not yet.
Yeah, so Jeff, I think that if you could give a little bit of a perspective on the recent years of the market, right? We've seen 2008, there were no unicorns. Now 174 unicorns later, the market has changed. Why did the unicorns come about and how it's evolving now? How many zombicorns are we going to see? And what's the perspective?
Sure. Well, first of all, thank you for having me. It's quite impressive what's happened here in the last 12 months since the Cubo started. So congratulations to everybody. And Rodrigo, I did forget about our very first meeting. I'm sorry you reminded me. It was a really bad idea. So, you know, it's been interesting times, kind of as it always is in Silicon Valley. And I think part of the advent of the unicorns, I don't like that word, but you know, overvalued tech companies maybe is the right way to say that. But you know, what happened is people saw, I think, companies like Uber, which are, you know, black swans and once in a decade kinds of events, and they extrapolated, you know, that if you invested in Uber at $1 billion, which, you know, is a considerable sum to pay for a small startup company, you could make 50 times your money, or 60 times your money, or we'll see when and if they ever go public what that could be. And what people did is they extrapolated that one event and said, well, if Uber, you know, if I can invest in Uber at $1 billion and still make 50 times my money, there must be other opportunities like that. And there are, but there's only one or two or three. There's not 146, I don't think. So it's a typical, you know, we've seen this many times in the Valley. Any financial business is very cyclical, and success brings more capital into a market, and when there's capital that's waiting to invest, it typically loses discipline around pricing. And so I think that we will continue to see really extraordinary companies being built, but I don't think that just because it, you know, a particular company thinks it's the Uber for such and such that it will ultimately be worth what Uber is.
And you talked about the influx of money, right? And there were a lot of non-traditional VC players coming to the table, right? You had mutual funds, you had T. Rowe Price doing massive rounds. How did that also help the equation or not? And how is that moving now that Fidelity is cutting valuations on all the unicorns?
Yeah, well, I think that's part of what I just described is that people saw traditional late-stage crossover and public stock investors were seeing that the public markets were fairly mundane. It was hard to make a great return, and they saw the kinds of multiples that some of these private companies were getting, and thought that it would be a good place to invest. And I think indeed for some of them at the right entry point it has been. I can tell you right now that I think most of those larger, the mutual funds, some of the bigger hedge funds, they probably haven't written a check in 12 to 18 months. They're not advertising that, but we have companies in our portfolio that are going out continuously for late stage financing, and it's a very, very difficult market right now. I think those are astute investors that recognize that the opportunity set wasn't what it was when they first started to invest in the private markets.
Now talking a little bit of how this is shaping, right? You touched a little bit that non-traditional investors are cutting back, that we see pressure on the later stage deals. So can you elaborate a little bit more and now talk and also touch on the resurgence of IPOs, right? We had, you guys had Twilio, you had HomeAway in the portfolio, Nutanix also IPO'd Cubo. Those are all billion-dollar-plus companies that did it over the last 4 or 5 months.
Yeah, well, it's turned into, I guess, what you would call a stock picker's market, to use a public market analogy for the private markets, where it's not a secular opportunity anymore. I think for a while, any tech investment was likely to turn out good if you were if you were the first money in, just because there was so much capital flowing in afterwards, it would float, the earlier investors. Now, people are very discerning, and the companies that are doing well have a lot of capital available at very high prices. The companies that are doing okay are having a very hard time to raise money, and the companies that are doing poorly, I think, the writing is on the wall. So valuations are being reset in general, but at the same time, kind of, incongruously, the IPO market has opened up for select companies, and it's a bit unpredictable. We have 2 companies that have gone public in the last 6 or 9 months. One is Pure Storage, and the other is Twilio. And if you asked us before they went public whether Pure would be worth more than Twilio in the public markets, we all would have said yes. And in fact, the public's fallen in love with Twilio, and it's worth 4 or 5 times what Pure is. So we're not very good at predicting what public markets will do or what they want to invest in. They're both fantastic companies with very high valuations.
Besides valuation, I got no idea. Died.
You broke it.
Yeah, I broke it. But besides valuation, what changed? What terms are we seeing now, or did we stop seeing that it's moving the market?
Well, I think what's going on is the same thing that you see, it's the reason markets are cyclical. And if you look at a bunch of different sectors, I'll use SaaS as an example. The software as a service companies, I don't know the timeline, 3, 4 years ago, were trading at, both privately and publicly, at 9 or 10 times multiple on their annual ARR. And today, it's maybe, depending on the company, 2, 3, or 4 times. The companies haven't gotten any worse. They're still growing fast. They're still, providing, they still have a beautiful business model that at scale, creates, I think, predictable earnings stream that investors value. But for whatever reason, both public and private market investors have, put a much lower multiple on it. So part of that is just, what you're going to see is a lot of companies, good companies, that have their valuations reset in the private market. And that's a very painful thing for small companies. That's called a down round. And I think we're going to see a lot of unicorns and a lot of smaller companies that have to reset their valuation. And it's not a bad thing. If you're a public company, your stock goes up and down, and you're marked to market every day. The issue with private companies and venture capital-backed companies that are still smaller is you mark the value of your company to market maybe once a year, maybe less often if you're lucky. And so if you raise capital when the multiples are high, you get a very high valuation, and then the next time you go to market and you raise money again and the multiples are low, investors are going to give you a lower valuation despite the tremendous progress that you may have made. And that's what's, I think, confounding and frustrating to a lot of entrepreneurs who sit there and say, hey, my company is 3 times bigger than it was last year, how can it be worth less? And I think there's a lot of public company CEOs who say the same thing, but they just say it on a daily basis, and it's a difficult thing for the culture of the company. It's a difficult thing for the employees who are there potentially for the stock upside, and so it's we're going through despite the success of some really big companies and some IPOs that have happened and some that are coming. I think it's a difficult time in private markets.
And how would you advise your entrepreneurs to prepare for this before they go out to fundraise, when they are fundraising? How should they think about the process and what to expect?
Well, maybe just to a degree repeat what I just said, which is it's all about supply and demand, and there comes a time for small companies where they go from the promise of what they can be to the reality of what they are. And at the earliest stages, when it's an idea and some really smart, committed people and a big potential market opportunity and a great product, investors can get very excited about what that could be, and they're willing to put potentially at times an aggressive price and write big checks for millions of dollars. But when you're in the market and you have comps and you have comparables, you have other companies that have a similar business model and that have the same kinds of growth rate and everything else, then you're going to be compared to those companies, and your value is going to be determined in part by the reality of your business. And that's a different mindset. So for earlier stage, to answer your question about what you tell it's very specific about what you tell each company, because depending on the stage of development and what the competitive situation is, what the risks are, and what the current market appetite for that particular technology. The other thing that is going on a lot in Silicon Valley is what's in favor and exciting and what's not, and that that changes very, very quickly in Silicon Valley. What's hot is hot, and what's not is not, and if you're not in the hot sector, at the time, it's a problem.
How will the fundraising process change for a company from the zero trying to fundraise and what extra challenges they're going to face?
Well, I think the main one right now is the situation in Brazil, which you guys all know much better than me, but it seems to be improving. But you don't read that in the newspaper in the States. I think news is kind of late to, or the sentiments is actually what's happened is kind of in a there's a latency and it's delayed. And so I think that Brazil was very hot, or perceived to be a very exciting market to invest in 4 or 5 years ago. As you know, there were lots of guys like me coming down here trying to write checks and meet people like you, but that changed fairly dramatically. So what I'm seeing happening is some very smart, discerning investors now, and so when the crisis occurred here, I think everybody left. what I'm seeing now is some really, discerning investors are believing that, this is once again, this is an exciting place to invest, and that if you get in now, you can enjoy not only the the growth of that particular company, but the macro growth that may be coming. The same thing that we saw in 2010-11.
Hi there. I'm Osvaldo Barbosa de Oliveira. I was fortunate to work for Microsoft for 32 years, and later was the president for LinkedIn in Brazil.
Wonderful.
Good exit,
Yeah.
isn't it? Yeah. But my question is, when you mentioned what's hot, what's not. I mean, what's hot in the next 5 years for Redpoint?
Flying cars. I'm only sort of joking. There is. I'll give you a longer list, but I think there's some really exciting things going on, and some of them will ultimately be exciting, and some of them will ultimately not work. But I'd say the traditional answer to that question right now is I think that artificial intelligence and machine learning are really important, interesting things that are creeping in to a lot of the products that we use every day and creating new opportunities. I'll come back to that because that's a longer conversation if you want to have it about that particular category. I think that software as a service continues to be very interesting. I think there's still, that transition is just, where it's low single-digit penetration of enterprise business markets for that type of software delivery. I think the mobile trend continues. There's still, great opportunities. It's, in Silicon Valley today with my smartphone, I can do almost anything. I mean, I can get food delivered, I can get groceries delivered, I can get my dog walked, I can, go anywhere I want, I can do my banking. I mean, it's very similar to what you see here, and that's, pretty impressive in, how quickly that happened. And then, I think that some of the crazier things that you're seeing are new types of computing. You're seeing photonics becoming very important. Ultimately, maybe quantum computing is around, is within our lifetime, if not, in the next 5 years. That will change the world in a huge way. We're starting to see some people invest in that. There's spaceships to Mars. There's, so I think there's a lot of moonshot kind, hyperloop, things like that people are thinking of new transportation systems. I mean, some really, really big ideas that I think will continue to attract the huge amounts of capital required, but it's hard to exactly predict how close those are to the market. And then the only other category I would say, which is virtual reality and augmented reality, both of which I think are, if you haven't played with it or seen it, any demonstrations, I mean, there's some amazing things going on. The breadth of the applicability and the size and growth rate of that market, I think, are a question mark still, just because of the price point and the actual usage beyond gaming and some of the traditional things for VR. But I think augmented reality is going to be a big deal.
Hi Jeff, Dana from Minutrade and Take. Despite of the crisis in Brazil and despite of what is hot or not, as you mentioned before, there is something that is calling your attention for Brazil in terms of any vertical in Brazilian technology or any main characteristics of our own ecosystem in tech here that you can point out?
Well, we came to Brazil because we thought that, aside from China, Brazil has scale. And for us to invest the kinds of to write the size checks that we like to write into companies, to be able to get the kinds of returns we want to get, the company's exits have to be in the multiple hundreds of millions of dollars. And typically that's within the domestic markets. And if you look around the world at what domestic markets could support companies of that size and scale. Clearly China is probably a multiple of the U.S. at this point, and the U.S. and I think Brazil, and I don't know what else there is, where else there would be that provides that kind of an opportunity. So it's the tailwinds, if you will, that we saw at the very beginning, which is the growth in the middle class and disposable income driving consumer opportunities, and then the big Brazilian corporate enterprises investing in technology to make themselves more productive. So those are the big trends that we think are important, and so what's attractive about Brazil is its scale.
Hi Jeff. I was wondering about your opinion regarding interest rates. How do they impact your investment strategy and the VC industry as a whole? And if you could talk a little bit about the specific situation in the US right now about the negative interest rates, and if it makes sense for you, if you think about the Brazilian market as well, that if you leave your money in the bank, you get like over 14% of return with almost no risks. So or are you just aiming for like 100 or 50%, 50 times return in 5 years, and interest rates don't make a difference at all?
Well, with the very strong caveat that I'm an engineer, not an economist, and even if I was an economist, I probably could not accurately answer your question. But we generally ignore interest rates. I mean, it's not a factor in our business in the U.S. The whole macroeconomic situation in the U.S. and probably here is almost irrelevant to the early stage companies that we invest in, because if you're a fast-growing company that has an opportunity in front of it, you're not going, the fact that interest rates are going up and consumers are spending less is not relevant to the first few stages of your company. And when and if that impacts your quarterly financials, you're a really big company. So we tend to not pay attention. Here, I think your question though is a really good one, and I don't really have an answer to it. When you have 14% risk-free, I'm not sure it's really risk-free, because I don't think it is a real return given the currency and everything else. I do, and then there's the exchange rate issues and everything else. But I guess I don't really have an answer to that question in terms of how you should think about it. I think the top quartile venture capital returns, typically have been and look to do about a 3x gross, 3 times gross return on your money. We always think in terms of cash on cash return to our limited partners. Occasionally they ask about our IRRs, but and we always calculate them just because, but what they're really looking for is a return of capital. And so, we look to provide a 3x gross, maybe a 2.5x net as a baseline return to our limited partner investors over a period, which is the big question, right? I mean, at some points it's a very quick time period, and at other points it's a little bit extended. But typically we have 10-year funds from start to finish. And not to get off topic, but I do think, coming back to one of your questions, I think one of the issues that we're seeing, and the reason that IPOs are increasing, is our investors and the institutional investors, for the most part, that are behind the venture capitalists, our limited partners, they're seeing great paper returns and very little cash back, because all of these companies are staying private longer. Very few are going public, and so they have no liquidity. And so they're very suspect, as the market has been turning, as to whether or not those returns are real. And so they're putting pressure on us Now we're putting pressure on, our portfolio companies to, have some sort of liquidity event, and that doesn't mean sell the company or anything else. It just means, potentially, go public or provide some sort of a market for these, to return at these peak levels.
Jeff, going back to your comment around comps, when you're looking at Brazil and you see much smaller competition, how do you see that playing or factoring into the pricing for the valuation of the companies looking specifically domestically in Brazil?
Well, that's a good point, and I think it's one of the reasons that Brazil is attractive to investors is that, there isn't enough venture capital here. So unlike in the US, where I'll invest in a company, I don't know, doing Groupon for cats or something, and there's all of a sudden there's 30 guys doing the same thing, and that creates a big problem, right? It means people fight for talent. They try and get the best people that know about cats, and they try and get, talent gets diffused to all of those competitors. They're all well-funded, so they all spend a bunch of marketing money competing with one another. And, it becomes not a zero-sum game, but it becomes much more difficult and much more capital inefficient to grow that. In Brazil, I think, there's been some of that, but I think, we strive to invest in the one or, the first or the second company in a category. That's where all the returns are made. If you're the third or fourth, even if you're successful, your multiple is just inherently going to be lower. And so I think when a leader starts to emerge and there's just the right amount of capital, and it usually goes into the leader, they can spend less on marketing, they can attract better people, and so it's their leadership is gains are more in a much more competitive market. So I do think that is one of the advantages here, and given what's going on in the U.S. soon there again, is that less capital is good. It's not bad.
Jeff, I have just arrived from the old world, from a very big FMCG company, traditional, and now I'm investing in one new venture, e-commerce. And yesterday I was discussing with my partner, with my stakeholder, because I'm concerned about cash generation. That is very common KPI in the old market. And my partner was saying to me, look, it's a different business. You don't need to be too concerned about this. There are some industries, e-commerce is very famous, e-commerce in Brazil, that they are working for 5 years and they still don't have cash generation. So my question is, the patience is different for a venture capital, and how long this patient take? 5 years is a long time. When you start to check this cash generation?
Well, that's a good question, and there's not a precise answer. I think ultimately, I think, if you look at the discounted future cash flows of a company is what should determine its worth. And that's why traditional old line businesses are measured in that way. We rarely, probably never, use that metric with growing companies. Again, one of the issues is you want to get to scale quickly, and to get to scale quickly and grow organically on your own cash flow is very, very difficult. But you want to pay attention to the business model that you're creating such that at scale, you can turn very profitable very quickly. And that's the trade-off, and I think it's influenced a lot by the market sentiments and availability of capital. What we're seeing a lot of, in fact, what we're having to tell a lot of our companies right now is exactly that, which is when capital is free, and when you can get access as much capital, and I'm exaggerating, but if you can get a lot of money at a high price, you should spend it for growth. Because in our market and kind of the emerging, early IPO market, investors reward growth, not earnings. Now it's kind of reversed, and people are looking very hard at unit economics. They're looking very hard at the ability to generate cash. They're looking at the burn rates and all of those things. So investor sentiment has swung even in the private markets towards a little more conservatism that way, and it's kind of whipsawed a lot of the entrepreneurs who build big organizations, spend lots of money on marketing, and going for growth only, and not paying any attention to whether or not they actually have a good business. Because until you look at the unit economics and the actual cost of acquisition or whatever it is within your particular business, your gross margins, your net margins at scale, you don't really know if you can grow really, really fast and have a really bad company when there's free capital. So that's the trade-off, and I think right now in the U.S. the pendulum is swinging towards conservative, conservation of cash rather than growth.
I want to go back to your previous question, to oppose them to that. You said that there's basically less capital sloshing around in Brazil than the United States, which makes perfect sense given the maturity of the markets. But three things. First, how does that compare to Brazil 4 or 5 years ago? Is there more than there was 4 or 5 years ago? Has it matured in the past 5 years, or has everyone left and is everyone now coming back in the same numbers? Second, does that mean that once you get more capital sloshing around in Brazil, you guys won't be interested anymore, and you will seek another market? I realize you said that scale is important, but there are sort of conceivably markets with big scale, like Indonesia or India or other places where you might want to plow your money in. And third, what does the experience of the US tell you about how long that phase of little capital and large opportunities may last?
Well, let me answer the second part of the question first, which is one thing we learned through all the cycles since I've been doing this is that you always have to be in the market and you always have to be investing. And if you try and time a market in our business, you can get lucky, but you drop the mic and leave. But I think particularly we learned this in 99, 2000 after the bubble burst, is you need to continue to invest in good times and bad, when there's too much capital and there's too little capital, because we're in a very long-term business. Often the best companies come out of the worst environments because, and a lot of what we've seen in our portfolio here in Brazil, is companies have to be super efficient. When you have little capital, you have to be really creative. It drives, not only in your product, but on your organization and how you get things done. And I think that's really, really an important discipline for startups, which is lost when there's too much money. So I think, we've made a serious commitment to Brazil. We'll be here, for decades, and it's not, I don't think, we don't try and do market timing.
I just want to add to that question, because that's something I had written here. We've started seeing large rounds being closed in Brazil, right? We have Nubank with hundreds of millions of dollars. You have Viva Real and many other companies that raised 30, 40, 50 million dollars rounds and are now going for 100. Is that a step change in the maturity of the ecosystem, or is that just a fad because the US market's so crappy? How do you see that?
Well, I hope it's a step change. I hope it's showing that these are real exciting companies and we're in a maturing market. And I think what Brazil ecosystem really needs is a handful of really good exits for investors. I think once that happens, there will be a lot more stability and opportunity in the environment here. So I'm not sure, to answer your first question, I'm not sure. There is probably an easy way to measure it, and someone in this room probably has the numbers, but it feels to me like there's probably money is starting. I mean, we peaked in 2000 here, in 2012, yeah. I think there was a lot of capital that was available here, and there weren't enough companies to invest in. Now I think there's more good companies to invest in and less capital, but I think it'll, moderate here pretty quickly. And I do hope that, what Rodrigo just talked about is the forerunner of some great successes here.
I just want to change the topic a little bit. In the US, we've seen people getting creative with VC models, right? You have the quantitative funds, you have the Andreessen Horowitz of the world, 500 startups, AngelList, and micro VCs, bunch of different models that didn't exist. How do you see that evolution? Why did it happen? How it's going to play out? Who are the winners or the possible winners?
Well, just to give you an indication of how long I've been doing this, when I was at school, I worked for one of two seed funds that existed in Silicon Valley. Neither of them are still in business. Hi, Andy.
I just brought you.
Got the mic.
All right. So there, I've seen a lot of models come and go, and I think that you kind of outlined the expanse of the kinds of things people are trying, from very early, seed funds and angel syndicates and things like that, to full service, full line, we'll build the company for you kinds of investors. Since we're in the middle of those things, I think that's the best model. I think, but there's pieces that we can learn from all of that stuff. I think, the angel model and the seed-only model is becoming increasingly difficult. I don't think you're seeing the real numbers come out of that. I think, people will talk about the one or two companies in their portfolio of 50 to 100 companies that have succeeded, but they don't talk about the 85 write-offs they had to zero. And, when you look, or, that they will have because they haven't potentially had it yet. So I think, that is not an easy thing to do. I do think there's some very good guys doing seed round, investing, but it takes a lot of commitment and sweat equity and a lot of great deal flow. Because the problem is, at least in the States, I can invest in 100 companies in 6 weeks, at the seed round, but I don't know that I've seen the right 100 companies. I don't know that that's the right number to invest in, and there's probably 5,000 I didn't see. So you have the selection bias that based on your network, and I think that's one of the biggest challenges in seed investing. And then the other extreme, which is I guess is becoming the Andreessen Horowitz model, where they staff up. I don't know how many employees they have. Probably 100 that are providing lots of services to these companies. That is something that works, but also is very difficult to scale, because the reality is, as an investor, I build a relationship directly with the entrepreneur, and as soon as our deal is done, I get on the same side of the table as him. And in the middle of the night, when he's got a problem, he wants to call me. He doesn't want to call my marketing person or whatever. And so I think that there's just a certain amount of bandwidth everybody has as an individual, and you need to carefully select the companies you're going to spend your time and energy on. And I don't think you can do that, with 6 guys and a huge portfolio. But if anyone can, they've been doing a very good job of it. So we'll see.
Well, I want to welcome Andy. Andy just flew in right now. Literally drove from the airport here. Andy has been with Silicon Valley Bank for 20-something years. So he has seen how the Valley evolved. He has served both funds and general partners. So he knows everybody. If you need to know somebody in the Valley, Andy's your guy. But they have also taken position as investors in multiple funds. So he will have also a perspective on the different models coming up. And I'll start with that first question for you.
Well, thanks, Rodrigo. Good afternoon, everybody. I'm sorry I was a little bit late, courtesy of United Airlines. Screwed up in terms of my flight times. I was supposed to have been here yesterday. Let me start by extending a hearty congratulations to Cubo. 1 year, it's amazing, and Cubo's already become such an integral part of the ecosystem here in Sao Paulo. So congratulations. So in terms of funding models, I think I think Jeff's done a good job covering the landscape. I think certainly there's been a proliferation of ways to get funding, particularly at the early stage. Whether you look at crowdfunding, you look at Angel List as a new platform to get early stage funding. The advent of micro VC funds, so funds that are less than $10 million up to maybe $50 million in terms of fund size. These are really proliferated in the U.S. as well. So there's a lot of new models, a lot of ways to get funding as an early stage entrepreneur today. And I think that very much ties to the level of funding activity that you've seen over the last couple of years, and certainly at the bank, because we work with nearly half of the venture-backed ecosystem in the U.S. Our client roster has really ticked up over the last few years because of the number of new funding models. Of course, it comes at a time where the cost of launching a new business has really come down, so obviously that's contributed to the level of activity as well. So from our view, I think the good news is that you have a lot of options available to you today in terms of how you get funding. I think as Jeff was covering, how do you then scale up your business from that really early stage to get early stage VC funding and beyond. I think I was looking at the U.S. venture capital numbers for the third quarter that just came out a week or two ago, and it really shows that the VC rounds are really highly concentrated today. You have the average deal size really going up, and you also have the trend of these kind of mega rounds happening. Zoox is an example of a $200 million Series A. I don't know if you guys have been involved in some of these big funding rounds, but it kind of distorts the numbers a little bit. You have a lot of capital that's being invested, but in far fewer companies. So how do you, as an early stage entrepreneur, kind of scale up and raise staged funding beyond? It's a little bit more challenging in today's market.
Yeah, we have a couple possible LPs in the room, and that's a dynamic that's very hard for people to grasp. How LPs interact with GPs, and where should you be investing? Where do you get access to? Can you talk a little bit about that? What's your experience with how do you get into the hottest funds, and how do you guarantee your space and stuff like that?
Well, I guess a good example, we're in Redpoint, so we're really lucky to be a partner there, as well as Redpoint eVentures here. Well, I think the bank has kind of a unique position in the ecosystem in the U.S. and increasingly globally. So I think our story is probably a little bit different than others as a partner to the industry for more than 30 years now. A lot of what we do, the work that we do, really helps us get access to some of the top funds in the U.S. as well. So our most of the organization is a corporate bank, but we do have a funds management practice, which has about $2 billion under management at this point, most of which is a fund of funds. So we do act as an LP. It's primarily a U.S. venture-focused model, and we have roughly 15 managers that are within our fund. And again, the names, Redpoint being one, we have Sequoia, Accel, Andreessen, some of the top funds, and the strategy or the value add that we think we're offering our investors is sort of access to these top fund managers, and quite frankly, these funds are all oversubscribed, right? It's really hard to get into being an LP in the top funds, and so part of our partnership over the years allows for some of that access. I think just on an interesting note, I think again looking at the venture capital dollars this year, I think it was about $34 billion have been raised by U.S. venture capitalists this year. And just putting that in context, at the height of the dot-com era, about $43 billion was raised in a year. So we're on track through 3 quarters to be one of the top fundraising years for venture in the U.S. So that certainly speaks to that venture as an asset, as an asset class is really attractive right now. A lot of good returns have been generated over the last couple of years, and I think certainly as an LP looking to get into funds, I think there's more being invested in more funds being created as well.
Do you want to comment on that, Jeff?
Sure.
The GP perspective?
Yeah, I think Andy, kind of described what and how we pick our limited partners, using the bank as an example. We've had a relationship with Silicon Valley Bank since our previous funds before we started Redpoint. So they've been a fixture and a reliable source of capital for both us and our portfolio companies. And so those are the kinds of people and institutions that we like to have as limited partners, because what we need is very patient capital. I think I mentioned earlier that our fund terms are 10-year partnerships, and then we typically have 2-year extensions at our option. So that's like a 14-year relationship, and a lot of people and institutions don't have that level of patience. And when we come back to the market, we typically raise funds every 3 or 4 years. We want to make sure that the guy that we've invested in that relationship still has interest, appetite, and capital to come into our next fund. So that's why these are, very long-standing relationships typically. We've seen a significant shift. Andy mentioned the numbers, in terms of the growth of assets under management in the U.S. and venture capital. Since I've been in the business, it used to be typically, high net worth individuals, university endowments, relatively smaller pools of capital that had access to a very small venture capital asset class. And now, over time, and over the success of the industry, there's a lot more, large institutions that are funding most of this. And so we've actually seen a decline in our traditional LP base over the past decades, and an increase of, both fund-of-funds monies and large sovereign wealth and pension funds and large pools of capital. And that's in part fueled, I think, what you ultimately flagged. I hadn't heard those numbers; those were a little scary. That there's too much, capital coming in, because we have some of our limited partners who will, say, hey, I'll only write a $100 million check into your fund, and we only have $400 million in our fund, so we're not, that's a lot of concentration for us. We don't like to take that large amount of capital from a single LP, because when we come back, or if we screw up, we have one bad fund and then they're not interested in continuing with us, it's a big hole to fill. So it's an interesting dynamic, and it's grown over a long period of time, but it has been a very relationship driven. Access has been driven by relationships.
Cool. Shifting back to startups, one of the things that we've seen lately happen in Brazil is Brazilian companies that compete globally, that are set up and designed to do so. There's PSafe, Score, Pipefy, and a bunch of other companies that are the vast majority of them very early stage, but they're not, I'm gonna be this for Brazil anymore, and they're setting up themselves as global companies. How do you see a Brazilian company competing globally and getting access to money in the valley and stuff?
Okay. I think it's really hard, and I wouldn't recommend it. Which is a way of saying that only exceptional companies should try it. And since if you think you're an exceptional company, you should try it, not listen to me. I think that we have companies that are set up globally, often from the beginning, but more often they grow that way, where they'll have potentially a development center in Israel or Romania or a lower, or in Canada sometimes, where there's a lower cost of engineering talent, which is very expensive in the valley. But I think it's very difficult from here to really understand and meet the market and build distribution for whatever your product is. And this is obviously a huge generalization. I think it's very difficult, and I think that if you really want to dominate, at least within the U.S., that you're going to have a significant portion of your business there, and your employees there, so that you're feeling the market every day.
Should a startup move?
It's hard to generalize, but if they're committed, and if that's the right market to enter, time-wise, I think they should move. I think probably the best example of that is Israeli companies. There's a lot of technical innovation in Israel that has a very small market, and so we see Israeli entrepreneurs building some really cool products and some really interesting technology that's broadly applicable, and they're in the world's tiniest market. So a lot of them try and run it from there and succeed in the U.S., and I think it's very difficult. So whenever we see somebody like that with a great opportunity, with a great product that could be a big hit in the U.S., we more or less say, I think you guys have, you have to move here. You have to show the commitment and the capability and to dominate the U.S. market. And I think that's kind of what's required.
And would you use Brazil as a base to go elsewhere? So now, going back to PSafe, they're going to Mexico, the U.S., GPass is going to Europe. So we've seen companies opening up markets outside of Brazil, still running operations from here. They're not U.S.-focused companies in general. How do you see that?
Well, again, it's very difficult to generalize. I think that the first thing you have to do is, if you're going to do the global expansion, the first thing you have to do is get your market, product fit, and financial business model in order here. Because if that's what you're going to use to fund or finance your expansion, you got to make sure it's working here. Well, I've seen a lot of Brazilian companies that were interested in coming to the U.S., but they didn't yet have a business in Brazil. And PSafe, just as an example, I think dominates the Brazilian market. They're very well penetrated here, and there's not a lot more headroom for growth in Brazil, so it makes natural sense for them to approach other markets to continue to grow. So I think at the right time, And with the right opportunity, it makes sense to go global or selectively into other geographies.
And how do you see that dynamic playing out both in Brazil and in other countries? You cover Argentina, which naturally exports a bunch of technology throughout Latin America. How do you see that happening? Why is it different Argentina than Brazil? Why companies build there do very well in Latin America, not so much Brazil, and things like that?
Sure, absolutely. I guess on the macro trend in terms of Brazilian companies sort of aiming globally and coming, therefore setting up in the U.S., and you mentioned a couple of pieces, Pipefy, etc. We certainly see an increase in the number of Brazilian entrepreneurs that are aiming to build global companies versus, I think Jeff and I started to get involved in Brazil around the same time, about 4 or 5 years ago. I think that early generation of entrepreneurs were very much, as you kind of said, Rodrigo, more localizing business models that worked in more developed markets. So we're seeing, certainly that shift to more B2B, SaaS businesses, some that can aim much more for global markets rather than the local markets. Now, that being said, I totally agree with Jeff. If you make the commitment to come to the Valley or to the U.S., you're swimming with the sharks at that point. It's a highly competitive market, but the cost of doing business is very high. But that being said, if you operate in the Bay Area, it doesn't take you very long to figure out that almost everybody is from somewhere else, right? But the founders have moved, made that commitment to be an entrepreneur operating in the Bay Area, and I think that investors look at that differently than you would someone that's trying to do it from Brazil. Now, in terms of other markets like Argentina, I think we kind of touched upon it, right? Brazil, with the large economy, 200 million people, it's kind of stating the obvious that most of you entrepreneurs aim for the local market first because it's big enough to grow a very valuable company. We've seen that play out many times over. Argentina, by contrast, a bit more like analogous to what Jeff mentioned about Israel, right? It's a smaller market with 30, 40 million people. The economy has been a basket case for a decade, but there's some silver lining now with the new Macri administration that's really supporting innovation as well. So that market may change in terms of entrepreneurs staying a little bit more in Argentina, but up until now, Argentine entrepreneurs have really, their early moves in building a business is to aim at a market outside of Argentina because of everything we've already described about the local market, and they can aim at larger markets like Brazil or Mexico, and we've seen many Argentine entrepreneurs be successful in scaling businesses in markets outside of Argentina, in a way similar to Israel. Another market I cover is Australia, very kind of similar dynamic, 30 million people, but they punch above their weight in terms of entrepreneurship. They export a lot of entrepreneurs. So I think there's some natural dynamics in terms of the local market that have the entrepreneurs looking to expand very, very quickly outside the local market. We are seeing more Brazilian companies expand regionally in our client base. Again, you mentioned some of them. And from a lay perspective, you think, gosh, if you could tackle Brazil and Mexico, you have 330 million people between the two markets, two largest economies in Latin America. Wouldn't that be great? But obviously, as I've learned along with our entrepreneurs that we work with, that's very difficult to do. A lot of cultural differences, expanding into even regionally. certainly has its challenges, and there've been, while a few success stories, obviously ones like Mercado Libre, there are many companies that have struggled to expand more, even regionally as well.
Do I have questions? I can keep asking forever.
Is it working? Hi Jeff, my name is Ophir, and I have an investment company based in the US but investing in Brazil. Question for you personally, what's the best, how do you think is the best rule of thumb for investing in a startup? What point of the life cycle you personally prefer to look at the startup?
Well, on a personal level, you know, I think like a handful, maybe a lot of venture capitalists. I'm a frustrated entrepreneur myself, so you know, I look at you guys and what you're doing, and I'm very you know, jealous. And so I like to invest very early and team up with the entrepreneur and pretend I have a little something to do with the success of the business if it wins, and nothing to do with it if it doesn't. So, you know, to me, that I'm not as I said earlier, I'm an engineer. I'm not a finance guy, and I'm not an economist, and I don't, you know, I don't invest in public stocks. I don't know anything about how stock markets work, and so. You know, I like to help build companies at the earliest stages, and that's where I like to invest. When it becomes a matter of, you know, reading the financial statements, although I can do it, you know, that's not the basis under which I typically write a big check.
When we look at the Brazilian market 5 years from now, right? For the past 5 years, we've evolved quite a bit. Now we're starting to see a lot of corporates starting to play a role. We had 150, 170 come through Cubo just this year. How do you see this market evolving over the next 5 years? What would be your first guess? And I know there is no crystal ball on that.
5 years. Okay, so.
Give it 10.
So I guess my crystal ball is a little bit more accurate if I pull that back from 5 years to a little bit closer. So I'm going to say at least within 2 years that there's going to be a real headline exit of some sort. Now we know that there are many many acquisitions that happen on a regular basis here in Brazil, but I'm talking about sort of a $1 billion exit, right? That's something to really pop on the headlines. I think that would be very affirming for the entire venture market here, and really would cause a virtuous cycle in many ways in terms of, again, if you look at a company like, let's take an analog like Mercado Libre in Argentina, and what that company's done for Buenos Aires ecosystem, and you'd have, what's spun out of that. Many investors, like the Kazakh team as an example, angel investors, new entrepreneurs, that all, an inspiration that the whole thing works, not to mention attracting more capital into the ecosystem. So I'd say number one, that within the near term, that there's going to be, whether it's an IPO, maybe a little less likely, but we know that there are a couple on that list, right, that are always talked about, like our friends at NetShoes as an example. But somebody, I think you're going to have a headline exit in the not too distant future. And we've been pretty encouraged. I mean, we have about 150 entities that we work with across Brazil, funded entrepreneurs, as well as venture capital firms. And we see the progress in terms of staged financing, the Viva Reals, the new banks that have raised, even in a difficult market, really significant funding rounds at valuation points that are really significant. And I think that's going to continue to happen. While some of the players are shifting in and out in terms of who's investing internationally, you are seeing new players come in, whether it's Founders Fund or QED has done a number of investments recently. So I think Brazil continues to be the largest, most developed ecosystem in Latin America, certainly within a five-year time frame. I think that lead and that maturity is only going to develop further versus Mexico, for example, which, interestingly enough, per LAVCA data, actually had more funding, more companies raise funding for the first time than Brazil. But by dollars, Brazil is certainly much, much greater.
Yeah, I would agree. I think we're on our way. I think we, it's kind of a trajectory is up and to the right, and I'm very excited about the next 5 years. I'm also a realist in that, I think it's never a straight line, and it's unlikely to be here now. But I think in that time period, it's kind of 2 steps forward, 1 step back, and I think we will see some bellwether, exits that will, really bring a lot more credibility and interest from other investors into Brazil. So I'm long term, medium term, very bullish on the ecosystem.
If we as an ecosystem were to fail, where would we fail? What are the biggest pitfalls that we can fall into?
Well, I've seen it. It's never fun, and what it is really good companies going out of business because they don't have access to capital, and a lot of that is outside of the control of the entrepreneurs. It's outside of the control of the existing investors, and it's just one of those things that happens when largely it's driven by investor sentiment or external macroeconomic shocks, and we started our firm in 1999, right before the dot-com crash, so we had a big portfolio of lots of troubled companies that were great companies, maybe half of them, that just couldn't get funded. And so, that's a really not fun thing to do, and I think that's probably the only thing that holds down entrepreneurs is lack of resource, and ultimately, that's again not the fault of the entrepreneur, but I think that's what would shut down the ecosystem. I don't think it's a big risk, but you're making me answer the question.
I guess I don't have too much to add except and I agree, the sort of availability of capital, follow-on financing. If you look at the funding gaps within the ecosystem, that's certainly the kind of Series C and beyond kind of financing is really largely dependent on international entrepreneurs. I guess looking at a little bit, inverting it a little bit to say that, gosh, in the next 5-10 years, can we get worse than we are today in terms of the geopolitical macro conditions? And if Brazil's ecosystem continues to flourish, even in these really challenging macro environment, that I think says a lot that the promise that once you get a little more wind behind your sails in terms of the macro conditions, even more development of the ecosystem can happen.
Great. Do we have any more questions?
Hello, I'm Gabriel from Innova Capital. How do you see the funding opportunities despite the macroeconomic scenario, but regarding the real meltdown in comparison to dollars?
Thanks. Well, I'm interested to hear what Jeff has to say. But it's certainly been a big concern of dollar-based investors, right? I mean, over the last couple of years, if you were investing 4 or 5 years ago, and venture exits take 7 to 10 years, right, to get to. So if you're investing over that time frame, the 5-6 years ago, the real was what at like 1.8 or something like that, right? So obviously we're in a very different environment today, and when you look at the growth on a real basis for many companies is phenomenal. but that gets completely washed away by the strengthening dollar, the weakening of the ride. I think the flip side of it is if you're investing now, I think it's a pretty good, pretty good bet that the real is fairly stable where we are today, and that it's not going to get much weaker, at least in kind of the near to medium term. And I think I suspect Jeff is going to say something along these lines where if you take a longer term view, if you are investing over 7 to 10 years, that you kind of take your bets with where the currency is. There's not much you can do to control that. But I think for new investors looking today, the assets are relatively cheap from a dollar basis.
Yeah, I don't have a different answer. It's really challenging, and it's not, it's been going the wrong direction for us. I think, but I agree, it's probably relatively stable now, and that's an opportunity. We don't typically try and time these things, and we are in it for the long run. So, when you invest at 1.8 and then you make great progress with the company, and then U.S. dollars come in and the exchange rate's 3.4 or whatever, that's disheartening to say the least, because the company's done great, but the markup in U.S. dollars terms is very low that we can show our investors or that the entrepreneurs enjoy. So, we've looked at and probably talked to you guys about how to, if it's possible to hedge the position and that kind of thing. And it's just, I don't think it is. It's there's too many unknown factors in terms of exit timing and everything else, and the amount of capital exposure. So we tend to just live with that.
Do I have more questions? Yeah.
Hi, my name is Fabian from Artemisia. It's an accelerator. So my question is, you talk about like cases and big exits in the next 2 to 5 years, but Brazilian markets for IPOs is not that great for small or mid business. I mean, BNF, Bovespa is trying to do something good, but never happened. They've been trying for a couple of years. So I mean, like, do you feel the need to adapt your investment thesis or process to this reality where the exits might not be in IPOs or might be in strategic buyouts and might have different multiples and all that differences for Brazilian reality?
Well, I don't think we have to adjust I think we entered, investing in Brazil with a pretty clear understanding of what the exit opportunities look like, and understanding that, they are more limited here than elsewhere. I guess I'd use China as an example to a degree, where, when we first started investing in China, which is the only other geography outside the U.S. that we invest in, I don't think any Chinese tech company had ever gone public in the U.S. And we've had, in our own portfolio, we've had 4, 5, or 6 Chinese companies go public on NASDAQ. Interestingly, now none of the Chinese success stories want to go public in the U.S. They find the Chinese stock market much more interesting. So, there's been a very quick evolution there, which has been, great to see. I expect that can happen here over the next couple of decades, but, we need great companies, and I think, to be built, and I think that as that happens, money tends to find good opportunity, and I think that whether it's a strategic buyout at a considerable exit value, or an IPO in the U.S. or elsewhere, and then ultimately perhaps, hopefully we can build an ecosystem here for Brazilian stock exchanges. So, but I think that Brazil is increasingly, or once again, I should say, strategic to a lot of global companies, U.S. companies, Chinese companies, and others view the opportunity in Brazil the same way we do as investors, and that they will pay a high multiple for the leading company in Brazil in whatever industry they're in. So I'm hopeful that that's, as Andy said, will happen soon and continue to happen.
I guess I'm an optimist, Jeff, but I guess first of all, as Jeff kind of alluded to, that most exits are going to end up in a trade sale anyway. And this notion of local exchanges is pretty prevalent around most parts of the world. Most ecosystems that we're involved with, they're just not really a good, suitable path for exit for venture-backed companies. For the most, I'm generalizing here, obviously. So I don't have a whole lot to add beyond what Jeff said, but I'm just curious in terms of, I do think that certainly U.S. and international buyers do see access to the Brazilian market as strategic. The question I hear from you guys is, when will local buyers be willing to pay strategic prices for venture-backed companies? I think that's one of the challenges. If we see more of that and see more local trade buyers willing to pay those multiples, and that'll be another milestone for the ecosystem.
Yeah, my gut is that that moment will happen when it starts to hurt. When Nubank hurts the banks will pay up for Nubank, and that's the deal. Our startups haven't hurt too much. They will at some point. But if there are no more questions, I'll set you free for lunch. We have lunch with entrepreneurs, with small groups, about 20 people per entrepreneur. We have 6 of them in each of the verandas, and then we have another one up top. The ladies are invited for the ladies entrepreneur lunch upstairs, sponsored by AES, on the back of the 5th floor. So thank you, Jeff. Thank you, Andy, for coming and sharing your knowledge.